All right, good morning, everyone. Today is Friday, November 22nd. Let's do a quick sound check. Please let me know if you can hear me. Ann, Chris, Greg, Jean, Miguel, Rich, Tom, Algia, and Victoria, Maureen. All right, very good. All right, so to begin, my name is John Paul. I'm going to show you a few of the methods that I like to trade. I'm going to cover a few things I think as traders that we all should understand and know. I like to make these webinars as interactive as possible. So what that means is if you have questions, please go ahead and feel free to ask me the questions. And I'll take a look at the Atlas line and the trade scalper and at the open. If any of the signals do occur, I want to see them. I want to show you how to trade them, discuss the stops, the targets. So I'm trying to be as interactive as possible for the next hour or so. All right. So to begin, I'm looking at the E-mini S&P. I'm going to add, just so we don't miss any of the indicators that fire off any of the signals. I have added the Atlas line, and I'm going to add the ATO as well. This is proprietary Daytradetowin software. You can find it on daytradetowin.com as well. And I'm also going to add the news as well, because knowing when the news is going to occur is important. So I'll add the news indicator. All right, so we have everything that we need here to begin our day. Typically, the day begins right after the market opens. I'm not sure if anyone here is an E-mini trader or a currency trader, but really it's the same thing. Depending on the market that you trade, as soon as the market opens, we should start looking at the opportunities to trade. Okay. Now, when I look at the market, I see these candles that are moving up and down, and I want to try to interpret what these candles are saying or what they're doing. And sometimes it's a little harder to do, and sometimes a lot easier to do. But the first thing that I need to do is add the ATR to my chart, so I understand if the market is volatile or if it's slow. And I have the ATR, the average true range here. This is the euro right now, Chris. Let me just switch that to the E-mini. So regardless of the market that you trade, you got it, Chris. Regardless of the market that you trade, if you are looking at the euro or the Australian dollar or the Canadian dollar, always add this ATR, the average true range, because it does give us the same information across all markets. It tells me how large these candles are, and it gives me a good perspective on what's happening. Now, the market just opened, so I can expect this is the overnight, so it's slow, and this is normal, slow activity. And then as soon as the market opens, you see that it begins to trade much stronger. And this is normal. What you're seeing is normal. So now I have an understanding of the ATR, which means 2 points. And 2 points would mean that each candle that has completed, on average, has made from high to low 2 points, which is 8 ticks. And this information is going to be used for target and as well to configure the stops. So at least I know how much of a target and how much of a stop to use. If the market is too slow, I should understand that, and I shouldn't trade. I'd like to recommend about a point as the minimum to trade, which is 4 ticks. Anything less than 4 ticks, you have a lot of whipsaw. So this is not something that I want to be involved with. And at the same rate, when the market is too volatile, which is closer to 5 points here, this is also a situation where it's too chaotic. And so you have to understand what that means. It means that every candle, on average, from high to low, has a 5-point spread from high to low. And so to keep yourself in a trade like that, the market is, in my opinion, going to be a little risky to trade unless you have a much larger stop. So you have to be careful when the ATR is above 5 or 5 or above and below 1. These are the extremes, and typically the market stays within this range. Now you have to configure that for different markets, whatever market you trade, especially if you're looking at currencies or during a news event. This can get a little bit chaotic, but we have to trade when it's the best opportunities. The best opportunities is when we have the market normal between 5 points and 1 point. Anyone have any questions on that? Chris, you okay with that? Maureen? And anybody else? Okay, so now we have a good understanding of the current conditions. Let's start to look for opportunities. The ATO, the at the open to, is an initial move that happens as the day begins. So we have a direction that the market begins to trade, and as soon as we understand that direction, whether it be long or short, I want to take advantage of that. So that's the ATO. It happens in a little while. The Atlas line is completely different. It looks at whether or not the market is moving above or below a certain zone, and then it provides opportunities to buy or to sell. So we have to wait until the Atlas line software begins to trade or begins to show itself. So I understand it's going to be a long or short. Typically about 9:50, 9:55, 10 o'clock, you start seeing orders. Now scalping is completely different. So when it comes to scalping, the market is looking at a very small target and stop. I prefer not to scalp and trade on the 5-minute chart at the same time. I rather do one or the other. So if I look here, let me just bring up the E-mini chart for scalping until we see here a signal. This is currently what you're looking at on the Trade Scalper, and some of you have the Trade Scalper software, so you're seeing the same signals as I have here. If you do want to trade pre-market here on the Trade Scalper, you can. You just have to remember 2 to 3 ticks because it's a little bit slower. We know it's slower overnight and pre-market. Just bring that back. And if you want to trade during the day session, you can take a little bit more profit on the scalper because it's more active. So sure, 4 ticks is fine. That's not a problem. Okay, questions, please. So this is what you're seeing right now. So if there's a signal on the Trade Scalper, sure, 3 ticks, 4 ticks, because we have a little bit more volatility. Pre-market, it's a little bit slower. So this is what we have. And what I can do is I can actually split up my chart here and make this so we can see 2 charts at the same time. And you can see the orders as they happen live on both of the methods. And remember, if you are going to trade this morning as you see it, a disclaimer, remember the risks of trading. Please don't trade with funds you can't afford to lose. I always tell everyone, practice. Use the demo or the simulator first and then start slow. Even if you want to start with the micro E-minis and then work your way up to the E-mini S&P, that's fine. But don't jump into trading, okay? You can use the 2 range. Chris is asking 700 volume. Chris, is that it? What you're asking? And I'm using a 2 range, Ann. Sure, I can show that to you. So this is 1000. I may have to adjust that to show you 700. So this is 700, Chris. Yeah, I would prefer a minute chart or a 2 range chart is much better. All right, this is just looking at it for the orders I'm seeing right now. All right, so we're looking at the orders as they occur. I have the 2 charts up. If anybody wants to suggest a market or a time frame, I'm happy to show that to you as well, as long as it fits into the day trading criteria as well. Something else I wanted to discuss this morning is phantom orders. And phantom orders are not something that a lot of people talk about, and you shouldn't understand what phantom orders are all about. So I'm going to bring up here a DOM, a price ladder. And I want to explain to you what this really indicating to you. This is a time and sales window. And a time and sales window is actual orders that are being filled and executed. So as you see it here, these orders are running through and exchanging hands. When you look at a dome here, and you see these orders here, these are potential orders to be filled. Let me just push this out of the way here. That. These are potential orders waiting to be filled. So the problem that we're trying to understand reading a tape and market profile is that the orders that you're seeing here waiting to be filled aren't guaranteed. They are, I call them phantom orders. I've been calling them that for a long time because you can't trust that at this price that there's actually 297 or 230 now contracts. It's very easy to remove and place orders within a second, especially if you have the robots and the algorithms putting on an order and taking it off. So you can't look at these numbers and say this is resistance because there's a large number there, or this is support if you see a very large number at a certain number of contracts at a certain value, a certain price, because they are manipulated. The market can be moved, or I should say these orders can be deleted and moved very easily. Just like if I was to put here, for example, a buy.
Order submitted.
If I was going to do a buy here, as soon as the price comes near it, I could very well just move it. And as soon as it comes close, I'll move it again. And then I can move it again. So you can't look at these values and say they are accurate, really waiting to be filled. Maybe 30 years ago, where you had to call your broker on the phone and say, place a limit order and then wait to be filled. Possibly that was tape reading a very long time ago. But nowadays, because of the way that computers work and how fast everything is moving, these orders can be manipulated very easily. So don't look at this, whether it's a stock. I just saw a report the other day that people do this all the time with stock manipulation, adding contracts thinking that there's more at a certain price or stronger support or resistance, but it's fake. Okay. And I'll show you gold in a moment. Joe, the trade scalper is on right here, is on the left, Joe, and it's on the E-mini S&P.
Order canceled.
If you can see that right there. So let me know, Joe, if you're able to see that. I have it already set up, and these are the orders overnight, but we're going to focus on what happens here live during the day with the orders live. Okay? So that's the first thing that we need to discuss. Phantom orders. Whenever I see an order that is very strong, very hard, at a certain price, I don't believe that there's going to be support or resistance at that price. If the market's in a strong trend, it's just going to blow through it, no matter how many contracts are showing, because they move them. They move them around. All right. And frequency programming as well, Chris. That's true. So that's the first thing that you should know. The second thing is limit orders and market of touched orders are very different. And I've done a few videos recently explaining the differences between MIT, market of touched, and limit orders. So I'm going to discuss these two different types of orders for you so you can understand when to use them, why you should use one over the other, and really what they mean, because you have a choice whether to use an MIT or a limit, market of touched or a limit. So a market of touched order is an order, for example, let me just put this out of the way here, is an order where it on the NinjaTrader price ladder on the dome here is green. So it acts like a limit order.
Order submitted. Like
this. And once it touches this price or whatever price you have the limit order at, it converts into a market order. So it's the same thing as if you just click market at that price, but you're waiting to be filled short or waiting to be filled long here.
Order submitted.
As the market comes down to fill you. Just remember, it converts into a market order. A limit order,
canceled,
on the other hand, says, I want this
Order canceled.
specific price or better. And so a limit order looks like this,
Order submitted.
or like this.
Order submitted.
So a limit order, once it touches this price, says, I want to be filled at 31.11 limit or better, but you're never going to get slippage on a limit order. And that's important, especially if the market is slow. You don't want to have slippage. You're fighting for every tick. So limit orders have their place and market if touched orders have their place. Now, why should you use one over the other? The problem is that when the market touches your limit order, you expect to be filled, but you don't always get filled. You will get filled. Oh, here's a long right here. So let me just do that.
Order canceled. Order canceled.
And so you expect to be filled, but you're not always going to be filled on. So this is 3109.50. So this is 31.901.50.
Order filled.
Just to show you here the trade scalper, right? 3109.50. I use the market if touched, so there's a tick of slippage. 3-tick target, 1, 2, 3. We'll just make it nice and easy. Here is this.
Order submitted.
Sell, and we put a stop here.
Order submitted.
Oh, I have to take off the ATM. Second here. Okay. So when you place this here, 3-tick target, you have a stop down here.
Order submitted.
And you're set on this here, on this trade scalper trade. So when you're looking at a limit order says, I want this price or better, right? So I want an actual price or a better price, but I'm not accepting a fill, and that's the slippage. So that's the difference between having a limit order and a market if touched. And there's a disadvantage to both. So the disadvantage is that when it touches your limit order, you're not always guaranteed to be filled. That's what I was referring to. So it could touch your order and touch your order, but you may not get filled because there's an order queue. An order queue is when you're in line to be filled, almost like a ticket system. And so what happens is that when you are in line, you have to wait until your number comes up, and the amount of contracts that are transacted also is enough to fill you. So a limit order has a disadvantage where you may not get filled when it touches your order, and you are in line waiting for those number of contracts to reach you. Okay, so that's the problem with a limit order. A market if touched also has a drawback because once it touches my MIT, you could have slippage. Typically a tick of slippage, or you can get the exact price, or you can get a better price, but it converts itself into a market order. So there's a disadvantage to having an MIT, and there's a disadvantage to having a limit. Questions so far? I don't want to confuse anyone between the differences between using a limit order and what that means with touching your price and not getting filled, and also a market if touched where you get filled, but you don't, but you can get slippage. Okay, so that's the problem with. Let me just cancel this here.
Canceled.
That's the problem with using one or the other. Anyone have any questions on this trade scalper? Chris, I think you were asking about this. I think it was Chris. Joe says here, can the trade scalper ATO be set up to auto trade the signal?